This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The next few videos to start bringing the chapter to a close are going to go through now and start to bring about looking at more detail with regards to beta, okay, and how we use that beta within CAPM to further appraise investments, whereby the investment that we're making is within a different business risk area, and it starts to get quite complicated because there's a lot of terminology, and if there's lots of terminology we can get quite muddled up. Okay, so let's just think about it and draw it up first. Let's just think that we are company A, okay, and company A operates in the airline industry, okay, so it flies planes all around the world. And what company A is looking to do is that company A is looking to acquire, we'll keep it simple and call it company B. And what you've got there is, let's just say that company B operates in the pharmaceutical industry. Now what you can see straight away there, by looking at the airline and the pharmaceutical industry, they have different levels of business risk. I think that's quite clear without me having to go through and explain any further. So what they will have is they will have their each own individual beta that reflects the business risk of that business. But don't forget as well, we said earlier on that beta not only reflects the business risk but also the finance risk, the fact that these businesses could actually have debt within them and could actually be geared, okay, and we've ignored that so far. Now we need to incorporate it slightly so that we can then start to look at that if company A is looking to acquire company B, it's going to have to appraise that project. It will appraise that project or appraise that acquisition using CAPM, won't it? Okay, and what we need to go through and do is we need to appraise that new project using the business risk of the pharmaceutical industry. So we will need to ensure that within there that CAPM reflects the business risk of the pharmaceutical industry, but that pharmaceutical industry will have a different level of gearing to what our company has. So company A will have a different level of gearing to company B. So what we need to make sure that we do, if we're appraising the acquisition of company B for company A, well, company A is owned by the debt and equity holders, so we need to make sure that it goes through there and reflects the level of finance risk of company A, okay, because it is company A that is going through there and doing the investment appraisal of acquiring company B. So we need to look at the different business risk that is reflected in company B, but we need to make sure that we adjust that beta in company B to reflect the finance risk in company A, not the finance risk in company B. Okay, so it gets quite complicated, but as we work it through, you'll see that there's lots of steps that we go through to ultimately get to working out the correct beta that will then help us in CAPM, that will then help us within our project appraisal. Okay, so that's, if you like, the big picture of the next few videos. Okay, we'll come back to it as we go through, because what we have to go through and do now is we need to start thinking about what's referred to in the notes as geared and ungeared betas. Okay, so we have a formula. Again, it's given in the examination. Oh my word, that looks horrendous, doesn't it? It looks ridiculous. Again, like with CAPM, you'll grow to learn it, you'll grow to know it, and you'll more importantly grow to apply it. Okay, let's keep it simple for now and cross out that last term. Okay, because in 99.9% of the times, beta D is the beta of the debt. So, you know, even though we say debt is relatively risk-free, there is a small element of risk attached to debt, isn't there? Because there's that slim chance that the government could default. Okay, so we have to reflect that slim risk. But we say that is normally equal to 0. So let's keep it simple. Okay, if that's the case, we've now got a formula which is a bit more simplified, whereby beta A is the ungeared beta. Okay, so therefore there is no debt, or if you like, it is the 100% equity financed business. If that's the case, beta asset is just reflecting the business risk only, isn't it? Okay, so if we go through, when we start playing around with this in investment appraisal, you know, if we've got company B, that reflects the business risk of company B. It will also reflect company B's finance risk. If we can strip out the finance risk from company B to give you a beta that reflects just the business risk only, then surely we can take that ungeared beta and then re-gear it to reflect the finance risk of company A for the new project business risk. Okay, that's why it gets complicated. We're thinking we'll have to de-gear it, re-gear it, it goes crazy. Okay, but keep it terminology at this moment in time before we get into the overall big finale, is that beta asset is looking at the business risk only. Okay, there is another, if you like, then reference to beta, which is beta E, okay, or beta equity. I prefer to talk about them as the geared beta. Okay, beta equity is the geared beta, beta asset is the ungeared beta. Okay, it's a little bit counterintuitive, isn't it, really? Because if you think that beta E is the equity, surely that would be 100% equity. No. Okay, and it's not. Okay, beta asset is when there is no debt and it is 100% equity finance business. Which is why I prefer to refer to it as ungeared and geared. Okay, ungeared is the business risk only. The geared beta, so beta equity, I shouldn't say that, should I? But that goes through there and reflects the business and the finance risk. Okay, it reflects both. Okay, so if we can identify a company that has a different level of business risk to ours, and we can use that to appraise the project from that different area of business risk that we are applying. I'm going too far, aren't I? But it doesn't matter. We can choose that beta of the other company, company B. We can de-gear it, okay, to work out the ungeared beta. So the beta purely representing the business risk, and then what we can do is we can re-gear it to reflect the level of finance risk in our current entity. Okay, challenging. Okay, so how do we link the two? Well, you've got the formula there, haven't we? Beta asset, so the ungeared beta is equal to the geared beta. And effectively what we do there, if you just look at the equity value compared to the total after-tax value of the entity. So we look at VE divided by VE plus VD net of the tax shield. Okay, so it does get quite complicated. Okay, because you need the formula. I think it's a more complicated formula to remember than CAPM. It's easy to get the geared and the ungeared betas on the wrong side of the equation. So I would actually go through, try and remember it, but do refer to it in the formula table when you're there tapping away on the computer in the exam. Okay, so do just be very, very careful. The key bit from this bit here is I want you to be able to understand what the ungeared beta represents. What does it represent? What risk is it reflecting within the company? Yes, just the business risk only. And beta equity, or the geared beta, reflects what? The business risk and the level of gearing, so the business and the finance risk. Okay, don't worry about this process of de-gearing, re-gearing, etc. That's me just going a little bit too far, but trying to give you a bigger overall picture of why we're doing what we're doing and why we're using this formula, because effectively we'll have to play around with the different betas. We'll be given different betas in questions and we'll have to do something to it to get the correct beta. But for now, make sure you've got the formula there. Make sure you know what the two different betas represent. And what we can go through and do now is we can play around with the question, can't we? Okay. So the example there starts talking about geared and ungeared betas. So remember, your geared beta could be there, if you like, beta G. Your ungeared beta is beta U, but don't forget, the ungeared beta is also referred to as beta asset, and the geared beta is there as beta equity. Ooh. Yeah, no wonder it gets quite challenging. Okay, the requirement, two parts, A and B. A, which is the more risky share. So remember, going back to the fact that beta measures the level of systematic risk. So the more risk, the higher the beta, because the higher the level of systematic risk. Okay. So what we've got there, it says P has a gearing ratio of 0.4 and beta is 1.8. So that beta, because the company is geared, is beta G. Okay, reflecting the business and the finance risk. Q PLC has a gearing ratio of 0.2. So again, there is some debt finance within it. So therefore, the beta that we are given is beta G, and that's 1.5, which is higher, 1.8 or 1.5, 1.8. So the P has the higher level of risk. Okay, excellent. Because you're looking there at the share, and the share, as we are geared, needs to represent the total risk of this business, doesn't it? Okay. It says then which company has the more risky business activity. So the risk in the business activity is reflected by looking at the ungeared beta, because that reflects the business risk only, doesn't it? Okay, so what part B effectively is saying, it's saying, well, look, you need to calculate beta asset, so the ungeared beta for P and for Q. So we're going to have to work out, is it beta U, the ungeared beta? So remember, we've got the formula there in that the ungeared beta is the value of equity, if I can get a straight line, divided by the value of equity plus the debt multiplied by 1 less the tax shield multiplied by beta G. Okay, whereby beta G is beta equity and beta U is beta assets. Stick to one or the other. Okay, to be honest, you probably need to be fluent in both, because the examiner will use different terms and interchange between them. What can you do? Okay, work it through. So what we're going to have to go through and do is we're going to have to go through there and do it for the two companies. Was that company P? And is that also company Q? Okay, P and Q. So what have we got? So for company P, it says that beta is 1.8 and the debt to equity is 0.4. Okay. So what we've got there, the equity if that is, say, 1, then the debt is 0.2 of that figure, based on, oh, careful, getting carried away, 0.4 of that figure. Nearly getting the two mixed up, got to be careful. What is the tax rate? Tax rate is there at 30%. So again, keep that as a decimal, 0.3. And the geared beta that we have is 1.8. So what I'd do is I'd work out the brackets first. At the bottom, 1 less 0.3 is 0.7. Times that by 0.4 is 0.28 and add 1. Okay, so get the bottom first. So on the bottom you should have 1.28. 1 divided by 1.28 is 0.78125 and multiplied by beta G, the geared beta of 1.8 works out there is that at 1.406. Okay. Again, we are assuming that there is debt that is risk-free, so beta D equals 0. Okay, hence we're using the abbreviated version of the formula. In terms there of Q, why don't you go through and try and work out the ungeared beta or the asset beta for Q. So I would stop the video and then restart it in a moment once you've worked it through. Okay, excellent. Right, excellent. Did you stop it? Okay, I hope you did. I think you should find there that for Q it's 1.316. I've just rounded it to 3 decimal places. I think in the answer it does it to 2. You just need to follow what you have within the exam question. So 1.316. Where did that come from? Well, now the geared beta is 1.5 and the debt to equity ratio is 0.2. So what you've got there is it's 1 over 1 plus 0.2 multiplied by 1 less 0.3 times by, was it, double check, the 1.5. Okay, so again, work out the brackets first. 1 less 0.3 is 0.7 times by 0.2 is 0.14. Add 1 is 1.4. Okay, 1 divided by 1.14. Did I say 1.4? It's 1.14. Okay, sorry. It's 0.87719298825, and then times that by 1.5. Okay, it gives me 1.315789474. To you and I, 1.316. Okay. So to answer the question, we have calculated the ungeared beta. Remember, that reflects the business risk only, because we have removed any impact of the debt. We're just looking at it as the equity element. Okay, as if we are ungeared. And therefore the higher of the two now is it the P? Okay, so P also has the higher level, is it the of business risk? Okay, there we go. Excellent. So P is overall the most risky. P also has the higher level of business risk. Excellent. Could be questions like that within the exam, so practice them within the revision kit of your chosen tuition provider, and if you get stuck, then by all means ask away. Just be careful, this is challenging and we haven't yet finished the chapter. Okay, there's an extra bit that we'll look at in the next video that brings it all together by looking at what we spoke about initially. The fact that what we're going to have to go through and do is identify a business that we're looking to acquire, look at a beta that reflects the business risk and the finance risk of that company, strip out the finance risk, so effectively de-gear it, okay, like we've just done in that example. But then there'll be another step now to then re-gear it to work out the geared beta that reflects the finance risk as well. Okay, yeah, I said it would be tough, and I don't lie. Okay, so strap yourselves in if you haven't done so already. Take a break maybe before we look at the next video to just recap things, work some of the questions in the study text of your chosen tuition provider to make sure that you can do some of the small examples there before we then go through and finish it all off. See you all soon.